So before we start our lesson, can you please go to this website www.hellosmart.com and sign up as a guest. Use your clean name, and also use this number, ID number 598751. I'll repeat that again. Go to a website. This the website www.hellosmart.com. Sign up as a guest. Use a clean name and use this number 598751, so that you could be part of this learning system. So this afternoon I'll be teaching you accounting. So remember, before we talk about directors, yesterday we were talking about shareholders and the roles of the shareholders, and also the roles of directors. So that's where we ended yesterday here. That's where we were yesterday. So remember, just to recap a little bit, the roles of the shareholders, remember, these people are the ones who are owning the company. They are the ones who are providing capital to the company. And the directors are the ones who are coming with who are doing the decision making. They're doing the greater part of the decisions, whereby what to be produced and when to be produced. They are the ones who are driving the company to make it fruitful. So, but today we'll be talking about the roles, the auditors, and the roles of the auditor. That's where we are today. Auditors and directors report. So now, remember, and for those who are learning accounting, you want accounting to be interesting. You heard a lot of people that say that accounting is difficult because of they don't love the subject. So you got to love the subject. So as I'm teaching future accountants. I see future accountants. I see future auditors. I see future directors. I see future CAs. You have to enjoy this. So now I'll try to explain it and make it simple so that you should understand what we'll be talking about this afternoon. So auditors, what is an auditor? I'll try to break it down so that you should understand. An auditor is someone that comes behind an accountant, whereby maybe an accountant has recorded all the transactions. An auditor will come and check if the accountant did the work proper. And if no one stole the money, I'm trying to break it down so that you should understand. No one stole the money. Did they comply with the law? Did they comply with the memorandum of incorporation of the company? You see, that's the duty of the auditor. So an auditor actually checks that the work of an accountant is done proper. So I hope that you understand what is an auditor. So now an auditor, always there is a different types of auditors. There is an internal auditor and there is an external auditor. An internal auditor is the one who works for the company, and external one is the one who's independent. He'll be hired by the company maybe once in a year to audit the financial statement for the company once a year, independently so. But we'll go through that. Next slide. So let's talk about the auditor's report. An auditor's report provides an opinion of the validity and reliability of a company or an organization's financial statements. The goal of an auditor's report is ultimately to document reasonable assurance that a company's financial statements are free from material error. Remember, we are living in the days whereby you find people can do fraud, people that can steal. That's why we've got auditors. So when auditors come, they come and check if financial statements they are not manipulated. You see, and they come and give a report. You see, so the company itself, let's say we have this company, ABC company. It will have its auditors. It will have its own financial managers and its accountants and its auditors. They'll do their job. Once they're done, the external auditors that are independent will come and check if they have complied with all the rules and regulations and give a report and their own opinion. I hope that makes it clear for you. Let's go to the next slide. The auditor must be a member of a professional body that is a member of the International Federation of Accountants. The auditor must be professionally experienced to audit the statements according to the accounting principle of GAAP and IFRS. Standards applied to an independent report, transparency and accountability. A company financial statement has to be accurate, complete, and complete financial record. So meaning that an auditor must check if or that all the financial statements comply with the standards of IFRS International Financial Recording Standards, and also that they were prepared accurate. There's no misinterpretation of the financial statement to gain a personal gain or to try to steal from people or from the shareholders, you see. But auditors, when they come in, that's where they have to check that all requirements and all the financial statements, they meet the standards and they're not manipulative or misleading. So what is an audit opinion? It's expressed on audited statement, usually after preparing a usually when the company prepares its financial statement. Okay, before I go to that, remember we've got what we call a financial year. A financial year is not necessarily from January to December. A financial year, it could be the time where the business started. Maybe the business started from the 30th of May or from the 1st of May. So that means it will go up to the 31st, the last day of April, the following year. That is a financial year. Doesn't have to be necessarily from January to December. It could be from the time when the business started. And that is the financial year. So after the financial year ends, that's where the company has to prepare its financial statements. And when it prepare its financial statements, then they submit those financial statements to the auditors. And the auditors, that's when they'll give their own opinion after preparing those financial statements. So it is required that an auditor state in the opinion that generally accepted accounting principles have been followed. We have talked about this, have been followed, that they have been applied on basis consistent with that used to proceedings. Types of audit opinions. Unqualified opinions. The unqualified opinions has no reservations, no consent, and there is no reservations concerning the financial statements. This is also known as a clean opinion, meaning that the financial statements appear to be presented fairly. And qualified opinions, this means that the auditor has taken exception to a certain current period according to a certain period accounting applications, or is unable to establish the potential outcome of a material uncertainty. Disclaimer opinions. This is a special type of audit report that should be issued when the auditor permits his or her name to be associated with financial statements that were not examined in accordance with generally um, accepted audit standard. That's when you find out that an auditor will report if the company didn't meet the standards of the IFRS or according to the standards of accounting or a companies act. The auditor will quickly report that matter to what we call IRBA. You see, the auditor will report that misconduct immediately. So now, an auditor, actually, it could be a person or it could be a juristic person. Juristic, remember, it could be a company. Juristic doesn't mean it's a natural person, it's a company. That's why you hear about companies like Deloitte, KPMG, Ernst & Young. Those are juristic auditors. The adverse opinion, this is a type of audit opinion, which states that the financial statements do not fairly present the financial statements. Changes in financial position in conformity, which generally accept accounting principles. So I want to show you how an audit report looks like. This is an example how an audit report looks like. Independent auditors, remember, an independent auditor is not an auditor that works for the company. An independent auditor is an auditor that works independently outside of the company, whereby the company will hire. It's required by the law that the company must have external auditors, depending on their public score. But they must have an external auditors, whereby auditors from outside will come and audit this company here. The reason being is that so that it should benefit the stakeholders, the shareholders. You see, because of if let's say the company is not audited, there could be a lot of misleading information, and people who are working for the company might take advantage of that. That's why there has to be external auditor every year, every financial year. So an external auditor is an independent auditor. So an independent auditor's report to a member, this is an example of how the report of an independent auditor looks like. It will say independent auditor reports to the members of the ABC Limited, and report title, you can use any title of that company. We have audited the company, we have audited the company financial statements of the ABC Holding, which comprises the financial statements of financial position as at the date. We're going to include the date, maybe from as at the year end of the financial year, and the statements of cash flows for the year then ended, and the summary of significant accounting policies and other explanatory information. Introductory paragraph. You know, you matriculants, this year you're lucky. In my times, when I was doing grade 12, this was not included in our syllabus. So you're lucky. You pass this, you won't struggle with your first year and second year in university. You won't struggle, I'm telling you. So take this very, very serious. It will benefit you. So we're still continuing with the example of auditor's report. How does it look like? Management's responsibility for the financial statements. Management is responsible for the preparation and fair presentation of these financial statements. Remember that management Remember that management is the one that brings the report to directors. And the directors, they make decisions based on what they received from the employees, which are the management, the CEO of the company, the top management. They get reports from them. That's where they get information and they make decisions based on what they got. So management must they must be responsible to give the right information to the auditors so that they should make preparation, fair presentation also on financial statements. We talked about this International Accounting Standard Board. Let's go to the next slide. Auditor's responsibility. An auditor's responsibility, remember, an auditor mustn't be a disqualified director. An auditor mustn't be someone who was charged of theft or who was fined or who was declared delinquent. So an independent auditor mustn't be someone or an employee that works for the company. That one you have to remember. An auditor's responsibility, our responsibility is to express an opinion on these consolidated financial statements based on our audit. We conducted our audit in accordance with international standards on auditing. Those standards require that we comply with ethical requirements and plan and perform the audit to obtain reasonable assurance. And this is very important also. Ethical. Also in accounting, there are ethics, where all the accountants and auditors have to comply with. We're still talking about auditor's report. An audit involves performing procedures to obtain audit evidence about the amounts, the disclosures, in the financial statements. The procedures selected depend on the auditor's judgment, including the assessment of risks of material misstatements. We talked about this. That's what auditors does. They check if there's no misstatement, no misleading information or misinterpretation of statements. The financial statement, whether they're due to fraud or error in making those risk assessments. Remember, the job of auditors is to protect the stakeholders, protect even the shareholders. Because if they're not there, what happens is the directors can use the very financial state, they can use their power to do their own personal gain in the company. And no one will know. You see, they can steal from the company. So that's why they are auditors, to protect the stakeholders, the shareholders, the customers, the suppliers, also the government, and also the community. An audit also includes evaluating the appropriateness of accounting policies used in the reasonableness of accounting estimates made by management. This is also important. Estimates. I believe you accounting students have done something like depreciation, amortization, whereby assets they depreciate. So sometimes people they can claim that maybe an asset depreciates maybe by 50%, whereas it has to depreciate by 10%. So when auditors come, they check that why do you overstate this? You see, why did your estimations are so unfair? Because sometimes people they may do that to gain a certain interest in the company. to manipulate, to do fraud. That's why auditors, that's where auditors come in, to check, to go through all those things. Let me repeat this. An audit also includes evaluating the appropriateness of accounting policies used and the reasonableness of accounting estimates made by management, as well as evaluating the overall presentation of the financial statements. We believe that the audit evidence we have obtained is sufficient, appropriate to provide a basis for our audit opinion. Let's go to the next slide. In our opinion, the financial statements present fairly in all material aspects. The financial position of that will be the name of the company here. The name of the company here, limited, as of the date, and of its financial performance and cash flows for the year. Remember, there is the 5 elements of accounting. Those you have to remember. I think by now you know them. Cash flows for the year then ended in accordance with international financial reporting standard as issued by the IASB, International Accounting Standard Board. Okay. Let's go to the next slide. Okay, this is an example of an audit report. Directors also report on their responsibilities in the statement of responsibility. Also, directors, they've got also responsibility. Got the responsibility to report all the responsibilities. The directors also present separate directors report to shareholders. Remember, these directors were appointed with a knowledge that they will carry out the business, and they've got to say, they've got in their duty, they've got to serve their duty with skill, diligence, and care, and with the best interest of the company. And they've got to make an annual report on how they carried out their duties, their responsibilities. So the report gives an overview of what happened in the business during the year and cover the following: the nature of the business, short overview of results, like example, earnings per share, the company's growth, and how they will get the dividends, how the dividends will be paid, and how many shares were authorized, and how what will benefit also the shareholders, and how will they carry the business further. Example of directors report, we are still on there. Director statement of responsibility. For the year end, the board of the directors, we put the name of the company here, ABC Limited. For now, we'll say our company is ABC Limited. It's responsible for the preparation of the integrated annual report and annual financial statements. I hope you remember that your financial statements, the statement of comprehensive income, some they call it income statement, statement of profit and loss and other comprehensive income, a statement of financial position, statement of changes in equity, that is dealing about the equity of the company, and then there's another one that is the statement of cash flow statement. So those are the financial statements that that the auditors also have to go through them, and also the directors have to give a report about them. In accordance with the Companies Act regulations of South Africa 2008, Remember this, companies, they're regulated. They don't just run their business on their own. They are regulated. So there is what we call Companies Act. Companies Act is there to regulate all these companies, to make sure that companies they comply with the law. So now there is Companies Act and there is what we call MOI. That is Memorandum of Incorporation. Memorandum of Incorporation, it's what the business draft. It's the policies of the company that they have drafted. And according to the law, it states that the Memorandum of Incorporation must not clash with the Companies Act. So it must parallel the Companies Act. It mustn't go against the Companies Act. Meaning that, just to make it simple, the company cannot come and set the rules that go against the Companies Act. Let me make an example. Maybe a company, it states that now it's the directors will be entitled to high income, maybe expensive holidays, and the company states that on MOI, Memorandum of Incorporation, that every year the directors will go on a cruise, get cars, expensive cars, whereas the company itself, it's about to be liquidated. It didn't pass the liquid ratio. You see, that's against the Companies Act. That is what we call it. It's called reckless trading when the directors do so, when they trade in recklessly, so knowing that the company is at stake to go down, and they go buy maybe expensive cars for themselves and manipulate financial statements for their own benefit. So Companies Act is there to protect it. It's like a standard to all companies. So directors have to comply with that. So the directors are required to maintain adequate accounting records. Remember, these accounting records are kept. They are not thrown away. They must be kept for a certain period of time. Directors are responsible for the preparation, integrity, and fair presentation of the company annual financial statements and related information included in this report. So it is the director's responsibility to ensure that the annual financial statements fully present. You see how this is so important. We've been saying it all over and over and over again. In short, it talks about honesty. It talks about honesty. Now, the directors and auditors have to be honest when preparing financial statements. You know, if people were honest on the face of the earth, I believe that auditing wouldn't be a big deal if people were honest. But this Companies Act, the role of auditors are there to protect the stakeholders from dishonesty. It also has to ensure that the statements are finalized in accordance with international financial reporting standards as issued by the International Accounting Standard Board, (SICA), financial reporting guides as issued by the Accounting Practices Committee, and financial reporting pronouncements as issued by Financial Reporting Standards Council, and that statements are in compliance with JSE listing requirements of the JSE Limited and the Act. The annual financial statements were prepared in accordance with IFRS and comprise the statement of financial position. I'm going to put it on a date here. The income statement, of which you can call it statement of profit and loss and other comprehensive income, and the statement of cash flows and related notes for the year ended. The annual financial statements are based on appropriate accounting policy, applied consistently and supported by reasonable and prudent judgments and estimates, assume ultimate responsibility of the system of internal financial control established by the company, and placed considerably important on maintaining a strong control environment. Remember, controls are there to minimize a lot of future damages or a lot of hiccups. That's why there is control. So I think we're gonna cover up. We're gonna come to the topic of control, internal control process. Let's go to the next slide. Adequately safeguard, verify, and maintain accountability of assets, as well as to prevent and detect material misstatements and losses. We talked about this. The company systems are implemented and monitored by suitably trained personnel with an appropriate segregation of authority and duties. You can see when control is being placed, the reason why we see this segregation of authority and duties. I'll just make a practical example. My name is Tai. If I am given a duty whereby I'm the one who approves payments, I'm the one who buys goods of the company, I'm the one who issues out funds, I approve, I issue out funds, I buy, I pay, I'm the one receive. When money comes in, I'm the only one who sees it. Chances are that I can steal from that money. No one knows. So now there is this control that is called segregation of duties, whereby, I'll make an example. There will be someone who writes an order, someone who receives money, and another one who says, no, this has to be paid to that one and that one. You see, and the other one is dispatching, is there at the warehouse, is the one who takes out the order. Segregation of duties. And there is another one thing who approves payments, who approves expenses, who approves income. You see how it works, this thing of segregation of authority and duties. So the aim of it is to minimize abuse of power, to have a personal gain in the company. Risk management in the company is focused on this. My fellow accountant students, it's very important, risk management. A company that doesn't have risk management, it's bound to fall. So every company, it has to have that risk management, and they have to focus on identifying any risk that will manipulate its financial statement or that could take the company down. The risk management in the company is focused on identifying, assessing, managing, and monitoring all known risks across the company. Although risk cannot be fully eliminated, that's so true. The company endeavors to minimize risk by ensuring that appropriate systems and infrastructure controls and ethical behavior are applied and that all actions are managed within the predetermined procedures and constraints. I think today we have covered a lot of things. The directors meet regularly through the company's audit committee. Okay, let's talk about this slide a little bit so that you may understand. There is what we call an annual general meeting of the directors, but directors have to have their own board meeting whereby they meet and they talk about issues relating to the company. Remember, directors, they are the ones who are giving the company direction. They are the ones who are making this company fruitful. They are the ones who are behind the driving force of the company. You see, so that's why they have to meet. They have to set up meetings, discuss certain issues about the company, and also remember, big companies, especially private companies, public companies, and private companies, it has also committees. There is a risk committee. There is a remuneration committee. There is also audit committee. And also there is a governance committee. But here you're talking about company audit committee and a company audit committee. This one, it's only auditors here in this committee. And there must be directors. It should be just directors, independent directors. The company assets and liability committee, the company risk committee. Okay, we spoke about this, that there must be committees in the company, and executive management to evaluate matters concerning the above responsibilities. Further details of this including the operation of the internal audit function are provided in the governance and risk management section of the report. The company's internal auditors independently evaluate the internal controls and coordinate their audit coverage and with management audit committees and external auditors. I think we spoke about this one. As for this, we spoke about it. Let's go to the next slide. The annual financial statements of the company were audited by that's an example, company's independent auditing firm. Remember, when we started, I talked about that an auditor doesn't have to be just a natural person. It could be a firm. So it could be a firm here. And remember, an auditor, regarding a natural person, he cannot or she cannot audit the company more than 5 years. So meaning that that auditor, his or her duration of auditing, it's 5 years auditing one company, and for that audit to come and continue auditing that, for that auditor to come to continue that auditing that company, there must be 2 years break, so that to that thing it's how can I put it? It's in the Companies Act, but the purpose of that is to eliminate risk of auditors gaining advantage of financial reports, whereby you find an auditor can manipulate also financial statements and is no longer independent. Now, is now like an employee of the company. And also, an auditor mustn't be, an external auditor mustn't be an employee of the company. Remember that, we spoke about that. They were given unrestricted access to all financial records and related data, including minutes of the shareholder, board and subcommittee meetings. The auditor's unmodified audit report appears on the page. Please, matriculants, accounting students, make sure that you study this theory. It's a lot of notes, but make sure that you study. It's very important. It will help you. Take it serious. I know this topic, sometimes people they will feel like, no, it's draining, but take it serious. It will help you when you go to varsity. Based on the information explanations of the management and internal auditors, the directors are of the opinion that this system of internal control provides reasonable assurance. Nothing has come to the attention of the directors to indicate that any material breakdown in the functioning of these control procedures. Remember, directors also they've got secretaries. Secretaries are those. It could be also a juristic or a natural person, but they furnish the directors with the act, with how to comply. You see, and also the directors can be assisted also by any employee regarding in decision making. The directors are therefore satisfied that the financial records may be relied on for the preparation of the annual financial statement. And remember, if directors mislead, they can be held liable. If directors, they quote that they are satisfied of this, whereas they know that they've manipulated financial statements or they are misleading, then they'll be held liable. Let's go to the last slide. The annual financial statements of the company are prepared on the going concern basis. The directors have reviewed the financial performance of the company as well as its no longer term focused performance based on the reasonable expectation that the company have adequate of resources to continue in the operational existence for the foreseeable future. Nothing has come to the attention of the directors that indicates the company will not remain a going concern for the foreseeable future. So I think for today, we'll just stop to this slide. On this slide, we'll continue from here. I think we'll continue on Monday. Please make sure that you study this. As we're done for the lesson for today, we'll continue from here, from this slide, and make sure, please make sure that you go to the website, go to www.hellosmart.com, sign up as a guest. Your ID number is 598751. 598751. So see you also on Monday. Come join us, join these lessons. They'll be helpful for you. Thank you.